Hello. Thanks for joining me today. Thanks for giving me a few minutes of your time. I appreciate it. Today, I want to touch on ICE's Mortgage Monitor report from February, so from this month. And as you know, with ICE's Mortgage Monitor report, it typically reports on loan performance, interest rates, property values. Sometimes it'll typically have a special topic each edition. This month, there really wasn't a lot going on with, mortgage performance. They're continuing to perform well, and there's not a lot of movement on interest rates, and there wasn't really a lot of new information about home appreciation. We have the Case-Shiller numbers in, we have the annualized appreciation at around 3%. So it's pretty tame information, pretty benign, but their special section this month was on the California wildfires. Now, as the California wildfires don't affect everybody across the country, but they do have an impact. They have a huge impact on California, a huge impact in LA. They actually have a pretty, as you'll see, wide impact, or will have an impact on our industry. And so let me share some of the numbers from the report. By the way, let me just show you the report. I'll put a link to this report in my notes below if you want to go check out. It's certainly worth tracking every single month. But let's get back to what the report said about the California wildfires. So there were, for the Palisades and Eaton fires in Southern California, there were about 17,000 homes in the direct path of the wildfires. And we don't know how many homes have been destroyed. They have estimates, but we don't know the exact number. But we just know that 17,000 were at risk. And the number is probably somewhere between 13 to 15,000 homes were destroyed. But so 17,000 of these homes are in the way of the fire, and with a total property value of about $45 billion. So those 17,000 homes have a property value of about $45 billion. That was based on ICE's AVMs for those properties. And by the way, with about, depending on, it varies by which area of the state you're in, but the land represents about 2/3 of the value of the home. So $1 million home means the land's worth about $600,000 and the construction is $400,000, roughly. It differs by location. But of those 17,000 homes, 13,000 of them have a mortgage. So 13,000 of them have a mortgage for about $11 billion in outstanding debt. Here's what's interesting. 60% of those mortgages are held in portfolios because they're jumbos. They're not held by the GSEs. So banks are on the hook for those failures if they don't get paid off. Is that crazy? That's a big number. 60% of those are held in portfolios. And so lenders are going to have significant risk. Think of First Republic, which is now Chase. Now, I'm guaranteeing you they have heavy concentration of loans in those neighborhoods. So some of the other things that the report pointed out, the fires, of course, compounded problems with affordability and home availability. Los Angeles is already struggling with, huge affordability challenges. It has the highest affordability challenge of any major U.S. market. It currently requires 67% of the median household income to purchase a medium-priced house. That's a problem, right? You have to spend 6% of your income to afford the house you're living in. Well, of course, historically across the country, that's less than 36%. In fact, for somebody that puts 20% down in a house in California today, the typical principal and interest payment is going to be around $6,000, which means you'd have to earn at least $184,000 a year to be able to afford the house, which is twice what the median income is in the area. So there's a lot of affordability issues. And now Los Angeles was already at below pre-pandemic levels of inventory. It was 21% below. So we already had a shortage of homes listed. Homes are already too expensive. And so now now a fire destroys whatever it is, 13, 14, 15,000 homes. It's only going to exacerbate the problem. So really, really big challenges there. And of course, challenges the lenders that are now exposed to some of these losses because in California, like many other insurance challenged areas, homes were oftentimes wildly underinsured or not insured at all. Several insurers have been dropping policies a ton of them recently, and many people hadn't yet got new policies in place. So there's going to be some devastation with that. But there's another surprising thing, which I didn't think of, and I appreciated seeing in the Mortgage Monitor report. There's 20 school districts and 17 different city or municipalities that were also exposed to these two fires, with a combined municipal debt on the at-risk properties of about $59 billion. That's right. All told, there's about 140 municipal entities that were exposed to the fire, and those 140 entities are linked to about 7,400 individual municipal securities or bonds. And for the first time, but we've really seen significantly, this is what the report said, for the first time we've seen significantly that there was an immediate repricing of the bonds in these disaster areas in Los Angeles. The spread on those bonds immediately went up, and the fear of default immediately went up. So you wouldn't think of it. If a school burns down, or a park, or the city hall, or a fire station, those things are financed by bonds, and the bonds, that's the debt, and now your collateral's gone. That's a challenge too. So there's all these challenges that these fires are causing, as we would expect, But I like to believe that we're a resourceful people, and we'll figure out how to get this fixed and how to get done. But I hope you find this information interesting, and certainly where you can help. But I appreciate you checking out my video today. As always, I did a LinkedIn post on this. It was a lengthy post. I have a lot of bullet points. I also have links to the Mortgage Monitor report on my LinkedIn, as well as I'll have them below. With that, thanks for checking me out today. I look forward to talking with you again soon. Have a great day.